Today, we're tackling one of the most emotionally charged and economically important topic in Australia, the cost of housing. Housing in this country has gone from being a place to live to being one of the primary engines of wealth creation in Australia. Over the last 3 decades, property prices have significantly outpaced wage growth. Household debt is near records high, and increasingly, the ability to own a home depends less on your income and more on whether you already own assets or having assets handed down from generations before. So the question we're going to explore today is this: is Australian housing expensive purely because of supply and demand and population growth, or have our tax settings played a major role in shaping this outcome? We'll unpack 3 key pillars that sit at the center of this debate. Firstly, capital gains tax, and in particular, the 50% capital gains tax discount. Secondly, the concept of negative gearing, what it actually is and how it allows property losses to offset high income. And lastly, how these 2 policies interact to create powerful incentives for leveraged property investing. This episode is not a moral discussion or debate about landlords versus renters, nor is it an attack on people who invest in properties, because many of us do, including myself. Instead, this is a structural discussion about the system, what behaviors does the system reward, and who benefits most from this system. And lastly, have the tax incentives created unintended consequences for housing affordability in Australia? Because when you step back and look at it dispassionately, Australia didn't accidentally end up with an expensive housing market. We actually designed a system that strongly rewards capital growth, leverage, and long-term property ownership. The question is whether that design still serves us today, or whether it's part of why young Australians are finding it harder and harder to enter the property market. Let's start by understanding how the capital gains tax system actually works and why the reforms in 1999 actually changed everything. Without further ado, let's dive into it. Hi everyone. Welcome back to another installment of the Investing for Dr. podcast. I'm your host, Dr. B. Now, before we can start talking about what capital gains tax discount is and what it does, I think we need to understand what capital gains tax actually is. So capital gains tax, or CGT, is not a separate tax. It is actually part of our income tax system in Australia. It is the tax you pay when you sell an asset for more than you originally paid for it. That is what it is at its core. Now, if you bought something, a property, shares, business, or even cryptocurrency, and later sold it at a profit, that profit is called capital gains. That gains get added to your taxable income in the year you sell the asset. Now, there are some important distinctions about how our system works. Firstly, you are not taxed when the asset goes up in value on paper, and you are only taxed when you sell it. That means you only get taxed when the gains are realized. And this is an important distinction because it defers the taxation event until you actually dispose of the asset. Now, let's use a simple example. So if you bought investment property for $1 million and sold it 5 years later at $1.5 million, your capital gains is effectively $500,000. So under current Australian rules, you've now held the asset for more than 12 months as an individual. You actually receive a 50% capital gains tax discount on the payable taxes. So at the end of the day, only $250,000 of that gain is added to your taxable income. That $250,000 is then taxed at your marginal tax rate. So if you're on the top marginal tax rate of 47%, you pay roughly $117,500 in tax. So although the gain was $500,000, the effective tax rate is roughly just above 23%. Now, of course, there are some important exclusions to the capital gains tax system. Firstly, your primary place of residence or your family home is generally exempt from capital gains tax. This exemption is very significant in Australia, and it actually plays a major role in wealth accumulation. And to be honest, your own residence is one of the biggest investment decisions you do make in your life. Now, the other distinction is that companies do not receive the 50% capital gains tax discount. They pay tax on the full gain at the corporate tax rate, but the corporate tax rate is not as high as the individual marginal tax rate at the highest bracket. And if you're a small business, that corporate tax rate could be as low as 25%. Which is only slightly higher than the 23.5% we talked about earlier in the personal income tax scenario. Now, lastly, another key feature is that capital losses can be what we call accrued or collected, and it can be used to offset capital gains. So that means if you had a capital loss in 1 year, you're not allowed to utilize that loss, but you can use it to offset future capital gains and vice versa. You can only offset losses if you had gains in your year. Otherwise, it goes into the accounting and you carry that forward until you have another capital gains event in which you can deduct the losses. Now, the interesting thing about this is that if you have capital gains and capital losses, the capital losses are deducted from the capital gains before applying that 50% discount. So structurally, capital gains tax does three important things. First of all, it taxes asset appreciation. So when the value of an asset goes up, you get taxed at it when you sell it. So secondly, it rewards long-term holding through the 12-month capital gains tax discount rules. And lastly, because you're only taxed when you dispose of the asset, it defers taxation until it is realized, which means that investors can compound untaxed gains for years and years before selling them. And that deferral, combined with the discount, is what makes the capital gains tax system such a powerful driver of behavior in the property market. Because what it actually tells you is that capital gains are taxed way more favorably than salary income. So you start to see why people focus on growth assets, and especially leveraged properties become so attractive. All right. So how does these things work in Australia right now? Currently, the majority of countries around the world actually do have capital gains tax system. So Australia is like many countries out there who tax capital gains. There's only a handful of countries that do not tax capital gains. For instance, the Bahamas, the Cayman Islands, UAE, Monaco, and Singapore. They do not have capital gains tax for all circumstances. However, in specific circumstances, they still do apply a capital gains tax system. But by and large, most of it is exempt from capital gains. Now, for those countries that do have a capital gains tax system, it is often applied differently depending on which country you're at. So in some countries, capital gains tax is taxed at the fixed rate. For example, in Sri Lanka, it's taxed at a flat 10%, where others are taxed at the marginal tax rate of the individual or whoever is paying the tax, like in Australia. So in Australia, obviously, capital gains tax is taxed at our marginal tax rate with the proviso of a capital gains tax discount if you held it more for 12 months. Now, obviously, Australia didn't always have a capital gains tax system. That was introduced a number of decades ago. So let's rewind the clock and go into some history lessons. Now, prior to 1985, capital gains were generally not taxed at all. So we did not have a capital gains tax system prior to 1985. So if you read any ATO rules around capital gains tax, if the asset was purchased prior to that, there was no capital gains tax payable upon disposal. So the idea is that whatever you bought before still had no capital gains tax. And that is the concept of grandfathering. So those properties or assets bought before 1985 were grandfathered into a scheme where even if you disposed of it 100 years later, you were not charged a capital gains tax on them. Now, in those days if you bought an asset, whether it's a property, shares, or a business, and later sold for a profit, that gain was tax free. So this obviously created some distortions because income from wages was taxed fully at your marginal tax rate, but income from asset appreciation wasn't. So in 1985, the then Hawke Keating government introduced a capital gains tax regime as part of a broader tax reform. So under the original system, capital gains tax were taxed at your marginal income rate. However, there was an important distinction and feature, which was called indexation. Now, indexation adjusts the purchase price of the asset for inflation. So for instance, you purchase something for $1 million and inflation was 10%, your base cost of that asset went to $1.1 million. So you did not pay capital gains tax on inflation. What that means is that you will only tax on the real gain, which is the gain above inflation, rather than what we call the nominal gain or the direct or absolute gains. Now, this was important when back in the 80s and 90s, inflation was running a bit rampant compared to today, and it was much, much higher. So that was obviously trying to account for that high inflation era. Now, as we all know, inflation was adequately combated and most of it fell to single digits, low single digits, in the modern day era. And then came an important turning point. So under the Howard government in 1999, there was a review of taxation. And the Howard government made an important change, which was getting rid of indexation for the cost base. So now individuals and trusts were given a flat 50% discount on capital gains for all assets held more than 12 months. Now, again, companies did not receive this discount and they continue to pay tax at the corporate rate on their full nominal gains. Now, this policy rationale at the time was to essentially simplify the system to encourage more investment. But what it did in practice was that the 50% capital gains tax fundamentally changed investor behavior. Why? Because it did not adjust or account for inflation. All right. This applied whether the inflation was 2% or 10%. And in a low inflation environment, the 50% discount was often much, much more generous than the old indexation method. So for high income earners on the top marginal bracket, the effective tax rate on long-term capital gains dropped to roughly 23.5%. So from 1999 onwards, Australia moved from a system where we were taxing real gain at full marginal rates to one where we are taxing half of what we call nominal or absolute gains at your individual marginal rate. This sounds like semantics and some slight, difference, but it actually has a profound implication for long-term asset ownership and investing decisions. So before we get into the next topic, which is negative gearing, just want to say that over a successive few decades, the capital gains was first introduced was an indexed-based system where you got taxed on your real gains to one where you're being taxed on your nominal gains, but at half the amount. All right. Remember that. Then second topic we need to talk about, which is the elephant in the room, is negative gearing. All right. Now, negative gearing is one of the most misunderstood concepts in Australia. And why is that? Because at its core, negative gearing is not a strategy, it's not a special tax rule, it's just a descriptive term for what you're doing as an investor. So when you're negatively gearing, you are doing two things. You are running a loss, which is the negative, and you are gearing, which is you're leveraging your investment, right? So it is simply a term used to describe when an investor borrows money to purchase an asset where the income produced is less than the cost of owning that asset. So it really just means that you are leveraging and owning something at a loss. Now, the investment is generating a loss to investor. Nobody wants to have a loss. So there needs to be a counterpart to it. So why are we having this loss, right? And what that loss is trying to do is that we are trying to have losses today to have future gains. Now, which ties back into the capital gains system. We'll talk a little bit more about that very soon. So the key concept now about negative gearing, which is quite unique to Australia and some other country, is the ability to tax deduct this loss against other forms of taxable income. So in countries where negative gearing do not exist, these investment losses simply disappear and vanish and they're not accounted for. So if you're running at a loss, tough luck. You shouldn't be doing that anyway. And so that is a disincentive to run investments at a loss. However, in Australia, this loss can be deducted against non-investment sources of income. So for instance, your wage. You can deduct your wages with your negative geared losses. So what this means is that you can actually offset your loss against another set of income. And this is what completes this negative gearing strategy we talk about in Australia. So when we talk about this, we're actually talking about both of these things, the ability to account for losses and deduct expenses from gains to the ability to offset that loss against gains elsewhere. Now, if you compare it to countries where there's no negative gearing, you basically got taxed on your gains, but you're not allowed to deduct your losses. And obviously, that sounds like a bad way to go about things. So in Australian law, as I mentioned earlier, you can deduct these investment losses against your salary. Now, if you are a high income earner, for instance, a doctor earning $300,000 a year, and your investment property was making $30,000 of losses, your taxable income drops similarly by $30,000. And at the highest tax rate, that $30,000 loss gets reduced to roughly $14,000 of losses. So you're basically able to offset your losses through deductions against your income. So what this means is that the holding costs and the holding losses against this property is nearly halved. So the after-tax cost of holding this loss-making property is roughly $16,000 only. And that is the power of negative gearing. It allows you to immediately crystallize your losses against your income and reduce the actual pain of holding something which is not making money. Now, it is important to make some distinctions here. Negative gearing does not mean that the government is paying you to invest, right? It simply means you're allowed to offset genuine losses against your income, sort of pay less income tax. So in a way, the government is actually subsidizing your losses when you have income producing assets that are making losses. All right. So this obviously doesn't apply to just properties. It applies to a lot of things. It applies to income producing investments as well, such as shares. So people can be sort of negative gearing shares, borrowing money against a share portfolio to invest in more shares. So however, in practice, the concept of negative gearing and the strategy is most commonly associated with properties, because property is one of the few assets in Australia that you can highly leverage. So at a 20% deposit, you're leveraging the asset 5 times. And in some extreme circumstances, such as only having a 5% deposit in the schemes that the government had introduced, you're actually leveraging up to 20 times. And that is a very, very high leverage ratio. So now we've talked about both capital gains tax and also negative gearing. We are going to combine the two of them to see how this combines to become such a perverse incentive to make losses in the short term to get future capital gains. All right. So, in our scenario, we have someone who has a high borrowing capacity. We have someone who can fully deduct the interest losses and investment losses with the expectation of a much higher future capital growth, which you pay half of the amount of taxes on. Does that start to make sense? Yeah. So we create a situation where investors, especially those earning high incomes and paying a high marginal tax rate, are willing to tolerate short-term losses in exchange for greater long-term gains that are taxed at a lower rate. So as long as the long-term growth is there, individuals will tolerate these losses today and almost socialize these losses by paying less tax. And this is why we see properties rental yield dipping below interest rates. So if you think about it, the cost of holding an asset is, say, 5%, but your rental yield is generating 4%. So you're making a 1% loss every year, right? However, because of negative gearing, that loss is halved. So you're only losing 0.5%. Now, if the capital appreciation of the asset went up by 3, 4, 5%, you're laughing your way to the bank, because on net, you are making income deductible losses today for future capital gains where you have to only pay half the tax on. So that is why many investors are utilizing negative gearing to allow them to hold a loss-making asset for a long period of time with a hope that there's future capital gains to be had where you pay less tax, essentially. All right. So now the logic becomes, I lose money every year. I socialize some of that losses by paying less tax, which I would have otherwise paid, and I'll make it back in time in the future when I do sell my property through capital appreciation, where I get taxed less. And that is the model. Now, on its own, negative gearing is not necessarily distortive to the market. And actually, many countries allow interest deductibility in some form, shape, or other. But the distortion becomes more pronounced when you can deduct that against income tax and pay less marginal tax on whatever you're earning. And it becomes even more pronounced when you're offsetting that loss today with a future gain that is only taxed at half your marginal rate when you put the 50% capital gains tax into play. And because that creates a vast asymmetry, you deduct 100% of your losses today and you only pay taxes on 50% of the gains. All right. And this is the difference that makes leverage growth strategy really, really attractive in Australia. And so when investors operate under these incentives, it actually influences their strategy, their pricing, their willingness to pay and overpay for assets. And we get a system where things are not very rational. Now, let's role play this a little bit and say, what if we were not allowed to negative gear these assets against our income? I think in that situation, people will be not willing to pay as much for a property because they get so negative on their losses that it doesn't make financial sense. Now, that extra pain is going to be felt by investors when they are essentially the cost of holding is way more than whatever yield they're generating. And in those situations, they might decide, hey, you know what? I'm not going to pay for a property that only gets me 4% yield. I might pay for a property that gets me 5% yield or 6% yield. And that has a different sort of pressure on the actual valuation of an asset. All right. And so that's why we see these crazy situations where you could buy a house that generates 2 to 3% rental yield, because we're not aiming for that rental yield. We're gaining that capital growth, 6% capital growth, 8% capital growth that comes year on year with the expectation that in the future, I don't have to pay much taxes on it. And that's exactly how the system works. Okay, so we've talked about the pervasive incentives, and obviously there's lots of other factors that affect, housing and affordability, pricing, etc. But in this way, the investor has a perverse incentive to almost overpay for an asset because they know that the value of their asset will keep growing. And until we actually demonstrate that the value of assets are not going to keep growing the same way it has, we're going to keep fueling this rise in prices, the declining yield in rental properties, and so on and so forth. Unfortunately, one of the things that actually does happen when interest rates fluctuate is that when the interest rate goes up, the landlords obviously feel the pressure. And so there is an incentive for them to actually increase the rent, right? And what does doing that achieve? It creates inflation, because housing is the biggest chunk of the basket of goods when we look at inflation. So these things tie hand in hand: higher inflation, higher interest rates, and so on and so forth. Obviously, there's a medium where a balance where we get to where it sort of just hovers along. But at the current rate, if we perturb the system, there is going to be knock-on consequences. All right. So now that we know what negative gearing and capital gains tax are doing to the system, let's look at what the proposed changes from the federal government and our current Labour government is purporting to do. So I think, we've been hearing a lot about changes to the capital gains tax system. And one of the ideas that's been floated is to reduce the capital gains tax discount from 50% to 25%. Now, the capital gains tax discount is obviously different in different circumstances. And that is, there is a prior to this, because when you look at the capital gains tax discount in superannuation, it's actually only 33% discount. So there is an argument that different amounts of discount can apply in different scenarios. But I think dropping it to 25% actually does get rid of a lot of the incentives for that future capital growth and paying less tax in the future. However, one of the problems by halving the discount is that you're also halving it from a nominal gains perspective. Now, the thing is that remember when it was initially introduced, we went from an index system where we're taxing the real growth to a system where we're taxing the absolute and the nominal growth by just applying a 50% blank discount. Now, this matters because, what is the biggest hot topic that's been going on for the last few years, which is inflation. Now, when inflation is high and, you have yield that is not as high as they are going, what we see is that it will actually diminish. You're actually not making as much real gains as you normally would have. So if they were to pare back the capital gains tax discount, I suspect there will be a point in time where we reintroduce indexation of the cost basis of calculating capital gains tax, because at this stage, with high inflation, the indexation method might result in a lower amount. So it's not as simple as just getting rid of the 50% capital gains tax or paring it back to 25%. We also need to make sure that it's fair and we're not overly taxing people on inflation, which has been quite high lately, and we really need to account for that. However, the other problem with making changes to the capital gains tax system is that, as we talked about earlier, capital gains tax is only taxed on disposal or realization of the gain. So I see time and point where they would need to bring back indexation for the calculation of the cost basis to make sure that we're not overtaxing people on actually the inflationary gains. And I think that just, again, is going to make the tax code a lot more complicated if we're going by this dual system. So the next case in point is that, as we spoke about earlier, capital gains tax is really being taxed at the point of realization or disposal of your asset. Now, one of the biggest things that could change is that it might not even make any difference if you just maintain a complete buy and hold approach. So if you do not intend to dispose of your asset, the negative gains tax changes do not actually affect you. So I'm not quite sure how much of this is going to have any immediate changes to the way that Australians invest in properties, because investing in property is a 10, 20, 30 year kind of endeavor. So there might not actually be an immediate change, because what you're doing is taxing something that might not happen or might happen 20, 30, 40 years later. And goodness knows what the tax code looks like and society looks like at that time point. So, I mean, look, is this a good policy? Is this a bad policy? There are strengths and weaknesses, and I'm sure people can argue this until the cows come home. But I think it is not the one strategy to fix the housing market in Australia. It will at most have modest effect on housing prices, because most people do not own multiple investment properties, and the majority of investors hold only one investment property, and that is the mode. Obviously, there are people who hold lots and lots, and again, that might not affect them if they do not want to actually sell the property, or they're just holding to convert it into a yield generating asset further down the track. So yeah, that's what I think about the capital gains tax changes that are being proposed. Now, where I think it's going to be a lot more interesting and have a lot more things done is to negative gearing and deductibility of losses across different income streams. Now, look, I'm not an economist and I am not trying to predict the future, but this is one of the risks that I do see going forward if anyone were to invest in property, is that the negative gearing and the transferability of tax deductions could be affected or could be changed, which is honestly what I call governmental or legislative risk in investment. And I think going forward, we need to consider these facts, because we see that Labour in social media and through other means have been signaling that negative gearing is broken, capital gains tax discount is broken, and so there is an impetus or almost a call to action to fix it. Now, how would we fix negative gearing? First of all, the original concept of negative gearing, as I explained earlier, in that we are borrowing money at a loss to hold an asset, they're not going to get rid of that, because that concept is essentially the deductibility of expenses. So you cannot say, hey, we're making an investment, we're not going to account for your expenses, we're going to tax you on all of your gains. That is simply not right, and it shouldn't be the place. It shouldn't happen. One example of this is what happened in New Zealand, where they had a brief period of time where they got rid of negative gearing, and that is, the ability to deduct expenses from income. And that actually created chaos in the New Zealand property market. So I actually don't think they're going to get rid of the concept of negative gearing, but what they can actually do is create new legislation to quarantine or ring fence the losses, investment losses within its own class or against salary and wages. Now, what this actually means is that if you have investment losses within, one of your assets, that loss will get accrued and it cannot be used to have tax deductions against your income tax. Now, what this means is that you cannot run a net deficit in your investment portfolio. Obviously, you should still be able to offset gains such as dividends from your share portfolio against the investment losses against your property, and that's okay, right? But by and large, the ability to deduct this against your wages is what is really distorting that have lots of losses now, future gains approach to property investing. And I sincerely feel that if the government was sincere about trying to fix the housing market, that's one of the things that they would tackle. It might be a situation where they slowly roll it out over a period of time, first starting with, everyone's allowed to have one investment property. You can negative gear that, but after you have more, you can't negative gear that anymore, to essentially going full blown saying, no, you can negative gear against your wages, but you can still negative gear against, say, capital gains tax or some other taxes that are taxed on income, for instance. And I think that will be a system that is a bit more palatable for people rather than getting rid of negative gearing completely. So that's my take on what they can do to fix negative gearing. Now, what are some other levers that governments can pull, right? We need to think about all of the different strategies that they could do to try and fix the housing market, try and reduce the amount that investors are overpaying for properties and that drive for properties to go up. I mean, simply the calculations and dynamics of owner-occupied versus investment property is completely different because of capital gains tax and because of negative gearing, right? So, for instance, when you own your own home, there's no negative gearing to talk about. You simply can't negative gear it, right? Because that's not a tax deductible expense. Now, there's also no capital gains tax to talk about. So when people purchase a property, they really look at how much rent they're paying, how much interest they're going to be paying, and they make a semi sort of logical calculation on what they can afford and what they should be paying, taking into consideration that the property might still grow in value in the future and they don't have to pay taxes on it. But by and large, it's more of a cash flow calculation rather than how much tax am I going to save in the future. Now, I think if we were to pare back negative gearing and perhaps capital gains tax into sort of more sensible sort of numbers, it could work. But again, I've not crunched the numbers. I think this is something that the government will probably be looking at either now or in the next election cycle if they still continue to have a sizable majority. But this is definitely coming because we are seeing some of the social media posts out there that's talking about paring back negative gearing. Now, some other potential policies that I have sort of thought about based on my experience in other countries. For instance, there's lots of other levers that the government can pull. And, that will be a combination at both the federal and state level. I think one of the concepts which the Queensland government tried to do, I think last year or the year before that, was to, actually nationalize the, land tax threshold. So land tax is a tax that is levied at the state level, and it's basically levied on anytime you own land, essentially. So it's a land component of your property, and you have to pay taxes on it. However, similar to owner occupied, your own home is exempt from land tax. So that system is already there to sort of deter investors in a way and also get a revenue stream from investors. But every state has its own land tax threshold. Now, what the Queensland government tried to do by sort of nationalizing that threshold, so if you own property in New South Wales, you're not going to get a land tax threshold in Queensland. That ultimately fell flat because there was no cooperation amongst the states, and it just didn't work out. But if the states were to ever come together and say, hey, we can nationalize that land tax threshold, that effectively gets rid of another strategy that a lot of property investors use, which is to own a few properties in different states to utilize their land tax threshold to not pay excessively, more expenses on owning property. Now, if that were to happen, I think it will reduce the overall number of property an individual will own. Again, as I said earlier, a lot of people only own one investment property, and perhaps that is a acceptable way to go about it. But what it will do is to reduce those individuals who own 10, 20, 30, 100 properties, because that would put an additional burden on their outgoings and their expenses. Now, this is one strategy, or all the states could gradually lower that to increase their coffers. As we know, most of the states are running huge deficits, as well as the federal government. So at some stage, all of the state governments need to increase their revenue, tax revenue somehow. And, this is probably one of them where we could see some changes in action in. Now, the last thing is where the government can pull some levers on is stamp duty. As we all know, stamp duty is one of those annoying costs that you pay just to own the property, and often a lot of people see that as an unnecessary tax source of taxation. Now, again, stamp duty is levied at the state level, and so again, this needs a lot of coordination from the states and the federal government for any changes to happen across the board. But essentially, we see stamp duty as another economic lever that governments can use to pull. For instance, in the first home owners, a lot of states are waiving stamp duty or giving concessions to it. And so by reducing it, promotes home ownership. But on the contrary, increasing it will reduce people who invest, especially when it's targeted at investors. Now, for instance, a policy that we can learn from overseas is one from Singapore. When you buy successively more and more properties, the stamp duty component goes up exponentially. And don't quote me on the numbers, but I believe after the second property you own in Singapore, the third property gets something like 40% stamp duty, depending on whether you're a Singaporean or you're a foreigner. And so that obviously puts a huge disincentive on owning multiple properties. And likewise, that policy can be put in Australia as well. It's going to be hugely unpopular for people who use properties a lot, but it is possible. Obviously there can be some caveats put into place, say, if your business owns the property, and your owner occupied property, it could be exempt from that stamp duty to not stifle small businesses. But at the end of the day, I think that's another potential lever that the government can pull. And this is not just at the state level, because the federal government can introduce maybe even a federal stamp duty. So, you're not siloed in your state by state, kind of play. And, again, that puts a brake on people owning multiple properties in different states. So there you go. These are my thoughts on, the taxes that we have in Australia for property, and, some of the strategies that people use, and what I feel is the changes that are coming to taxation and the property investing sphere. Hopefully, we're not caught with our pants down, and we can plan for these risks going forward. So make sure that we, don't over leverage, we don't go too negative on negative gearing, and that we can sort of sustain any cash flow hits in the short term. But again, in the long term, the goal of property investing is to actually make money and not to have continual losses. So eventually all those negative geared properties will eventually become positive as you pay down the principal and the interest component diminishes as well. So there you go. Share my thoughts on the housing affordability issue in Australia, what capital gains tax and negative gearing have done together to create the market we have, and what I think some of the potential levers that the government could be utilizing to try and fix this. The appetite is there, but ultimately We live in a country where governments get voted out. So I think it's going to be a balance of not pissing off too many people at the same time, but to still go forward with this agenda. And, I'm going to be a bit cynical about it. It's not all about increasing and bettering housing affordability. It's also a tax grab at the same time because, let's face it, we're still running a deficit. And at some stage, the cost of that deficit is going to become larger and larger because of inflation and interest rates. So yeah, there are my thoughts. I hope you enjoyed this episode. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.